In this video, we are going to go over an example of flow shift and what tools you can employ to trade such a situation. In this market, we can see the price just made a lower low in the major flow dimension, and that renders the last major high as a solid market extreme, meaning that it is a proven level made by the major sellers of this market. One detail that is worthy of noticing here is that the major high I just mentioned is highlighted by a nice low frequency in its upper tails, and as usual, it is also marked by a fractal bar on the top. It's very common to observe fractal bars in major reversal points like this. Since the market has traveled down for a bit and created the solid extreme, we expect that the market will make some sort of a correction, as buyers and sellers are always oscillating in who controls the market, meaning that the market doesn't tend to go in one direction for very long, unless we are dealing with an extreme situation. That means buyers will eventually pick this market up, and they will try to test the sellers that are already proven at the solid market extreme. In this chart, I already marked the inward frequency line that shows the point where this battle between buyers and sellers is likely to take place. So let's see what happens when the buyers correct the market to that level. At this point, we have a few more details that need to be taken into account. Price is now at the inward frequency line, which means that buyers will attempt to fight the already proven sellers from the major high we talked about in the beginning of the video. Notice also that there is a minor running flow forming. This minor flow is dominated by the buyers. That means the counterpoint between buyers and sellers of this market is in contrary motion. In other words, the major flow is going downwards and the minor flow is going upwards. The inward frequency line is where they are likely to meet and cause some sort of disruption. Observe also that there is some sort of reaction at the inward frequency line as price is testing it and failing to break it to the upside. For all intents and purposes, this can be a valid short trade opportunity since we have some context for the major sellers, and we are near a good place to put a stop loss order. We also have a lot of potential headroom for a short trade to travel to the downside. In other words, we have a small limited risk and a high potential reward. Let's see what the market does next. As you can see, the short trade idea is frustrated since the market advances to the upside and breaks the stop loss level. At this point, many traders would give up on the analysis, but being wrong about the analysis can also be considered as valuable information. We originally thought that sellers were in control of the market, but the failure in the stop loss order from the short trade opportunity proved us wrong. That can mean an opportunity to the upside now. We can see this opportunity by tuning our analysis accordingly. The line that was supposed to be a pivot for the sellers to show up ends up being a pivot that shows the failure of major sellers in face of minor buyers. At this point, we can start employing some line work to support the analysis. If we draw a standard pitchfork in the major points of the market, we'll observe an upsloping set of lines. One thing that catches the eye here is that the lower line of the pitchfork is not catching the lows formed by the minor bullish flow, so we can draw a parallel line that catches those lower frequencies. That's important because we have noticed that buyers won the battle against sellers, even though they are in the minor dimension. Observe that the alignment of the inward frequency line, which is acting as a switched support and resistance line at this point, and the parallel line found in the upsloping pitchfork point to an intersection point in the chart. We can think about a long trade opportunity in that intersection of lines using minor lows as our stop. The motive for this is that the minor flow seems to be dominant over the major one, and we have to go with the flow that appears to be dominant regardless of its theoretical strength. So let's see what happens next. Notice here that the minor flow has developed a bit more, creating higher confirmed lows, which means good places to put a stop loss order. The last confirmed extreme is sitting exactly at the switch level of the inward frequency line from the beginning of the video. Beyond that, the market just touched the intersection of lines and it didn't violate the intersection. The optimal trade here would be placing a buy limit order at the black parallel line with a stop below the last minor confirmed low and a target at the center line of the pitchfork. If we quickly examine this opportunity, we'll see that it has potential for about 1-to-4 risk-reward ratio, which is excellent. So let's fast forward to see what happens. As you can see here, the minor flow dominated by buyers takes us directly to the center line of the pitchfork, rendering the long trade opportunity a winner. Notice that even though the analysis was wrong in the first trade, the very fact that we were wrong could lead to a potential winning trade right after, and that shows the importance of learning from your mistakes in the analysis. That's it for this video. If you wish to learn how to analyze the market like this in much greater detail, please check out the video courses I offer in the video description. If you wish to support the channel, please click the like button, subscribe to the channel, share the video, and leave your comment below. Thank you for watching, and I hope to see you in the next videos. Take care.